Hi, good afternoon, everyone. Can you hear me okay? Terrific. My name is Yair Holtzman. I'm a partner with a consulting firm out of New York. We specialize in the area of obtaining R&D tax credits for the chemical industry. Our team is made up of chemists, engineers, scientists, CPAs, and attorneys. When I first checked in, she asked me what my talk's going to be about. I told her it's at the intersection, at the interface of chemistry and taxation. And the person who was checking me in started laughing. Well, hopefully you'll see a nicer, gentler, friendlier side of taxation today. I promise two things. Number one is we're not going to get into heavy tax law. That's not what we're doing today. And the other thing is we're not going to get into deep chemistry. What I'd like to show you, hopefully, is whet your appetite for an opportunity that's out there for you to capture and obtain some money back for money you've spent on R&D and manufacturing in the U.S. This research credit has been around since 1981. It started under the Reagan administration, and for the past 34 years, it's been retroactively reinstated. So every 2 years it would expire, and then Congress and the President would get their act together and bring this, resuscitate this another time, been resuscitated 16 times. This past December, Washington finally got its act together and made this thing permanent. The idea here is to really try and keep manufacturing and R&D in the United States. And this is one of the best incentives, probably the best incentive for a company to do that, because it lowers your effective tax rate dollar for dollar. I'm going to try to go light on the taxation side, but if you have any questions at the end, I'm going to be around, and I'd also be happy to provide anyone with a copy of the slide deck. So we're going to go through a little bit about the history of the credit, go through a few examples of what qualifies, what gets captured in this research and development tax credit, and how it can affect your company, and what types of processes you need to look at and consider when putting together a research and development tax study. Again, the credit's been around since '81. It's been temporary. It's been retroactively reinstated 16 times. It's been enhanced and changed about 5 times. I'm not going to get into the complexity of the taxation. The key takeaway, and I'm going to try to reiterate some key takeaways as we go through this. If you can't hear me, just raise your hand. I'm going to try to create some distance between me and the mic. The key takeaway is if you are innovating, if you are developing new products or processes in the United States, they don't have to be revolutionary, they could be evolutionary. You should be considering this, and if your CPA firm is not bringing this to your attention, which they might not be, because number one, this is a niche area of taxation, they might not think you qualify, they might not be familiar with it, or they might say, yeah, but you got to send it out to a specialty group, and they're right. You might be missing this. The credit gets reported on a Form 6765, which then goes to your CPA firm, and the actual study goes to the company. I didn't give you a little bit about my background. I actually started out as a chemist. That's why I'm here. I have a bachelor's in chemistry and physical inorganic chemistry, oscillating chemical reactions. I started my PhD at the University of Pennsylvania in looking at physical biological systems using NMR spectroscopy and X-ray crystallography. I'm a PhD dropout, did not get my PhD, and then went to work in the chemical industry. So the reason I mention that is twofold. Number one, when you do these studies, you don't just want a CPA doing these studies, because they could very well be leaving money on the table. You could be losing opportunities that could get captured and included as part of this research credit, number one. Number two, if you do get a very large credit, a day could come when the IRS might want to look at your backup and understand, well, are they really doing things that should qualify for the credit? Having us across the table from them is very helpful, as opposed to just having a regular CPA, because we understand, we speak the language of the companies at the show. So hot off the presses, like I mentioned, December 18th of 15, President Obama signed into law the Protecting Americans from Tax Hikes Act, which made the research credit permanent. The research credit is estimated about 12 to 13 billion a year. of money that's being shelled out, is being given out to companies, to corporations. The sad part about that is that 80 to 85% of that is getting shared by the Fortune 1000. And then the smaller companies across the country either don't know about this or are leaving money on the table. I could share with you, not a week goes by where I don't visit with a small privately held company, 20 million to 300 million in revenue and top line revenue, never heard about this, or CPA told them this doesn't apply to us. That's not true. As you'll see through the presentation, there are many, many areas of R&D tax law that are applicable. You don't have to be doing revolutionary work. You could be doing evolutionary work as well. This is a summary of the recent changes, and they're worth taking a minute. And again, this is probably as tax technical as it's going to get. The presentation is going to shift over to the product development side. So the first change is now we have a permanent research credit. Well, why should companies care? Well, you should care because now you can use this as a method to plan your tax liability, right? If I'm going to hire another 5 PhDs over the next 3 years, I might as well hire them today if I need them, because I can lower my effective tax rate, my tax obligation, as opposed to not knowing, well, is this going to be around in 17 or not? It's going to be around. The other thing they wanted to do is make this more attractive to smaller companies, under $50 million in revenue. So now, starting in 16, if you're under $50 million in revenue, you can capture this as well. The issue wasn't that smaller companies before weren't able to take advantage of this. The issue was they're getting stuck in something called the AMT, the alternative minimum tax. So small company, privately held, owner gets a research credit of $100,000, has a tax obligation. Well, you can only use the research credit to get the owner down to his AMT. You can't get it below the AMT. With this new change, you can now use your research credit against the AMT tax starting in 16. And lastly, they put something in there for startup companies. For businesses with no tax liability and gross receipts of up to $5 million, you can use this against your payroll taxes. So essentially, there should be no company that's doing anything innovative, either on the product side or on the operation side, on the process side, that's not looking into taking advantage of the research credit. Opportunity and benefits. Why is this so attractive? Well, it's dollar for dollar reduction of taxes. This comes on top of your deduction. So your CPA is going to say to you, you'll come back, you'll bring it back to your CPA, and they'll say, well, yes, I'm already taking all the deductions, and that's great. But this is on top of that. This is a double dip. You tell your CPA, I want to know whether or not we're taking the R&D tax credit, not an R&D deduction. There's something called an R&D deduction, a 174 deduction for R&D. This is the Section 41 credit. It's dollar for dollar reduction of taxes on top of your deduction for R&D. In addition to the federal credit, many states have state R&D credits. You should go after those as well. Again, the idea is the government wants to incentivize you to keep jobs and R&D and manufacturing in the U.S. versus going overseas. In the global marketplace, I could share with you there are 45 countries across the globe that had better R&D tax credit regimes prior to these changes than the U.S. Today, the U.S. has moved up dramatically in the rankings. So what is R&D for purposes of Section 41? And I can share with you, this is one of my biggest challenges. I'll meet scientists, and especially PhD scientists, and I have a great story. I had a PhD scientist from Princeton who I met years ago when I did some consulting work for Pfizer, and he says to me, well, on a particular project, he says this work shouldn't qualify because I think it was Amgen at the time. It was also trying this type of work, and that's not the threshold. You don't need to be doing work that's new to the world or new to the industry. As long as your company is pushing the envelope vis-a-vis where you were in the prior year, that's the threshold. That's the tax threshold of qualifying for this research credit. I like this particular cartoon for two reasons. Number one is people keep going back to tax deduction. This is not a tax deduction, right? This is the tax credit on top of your tax deduction. And secondly, you don't need to be creating life, right? We've already mentioned that. Evolutionary doesn't have to be revolutionary. I'm going to try to hit on some key, key points. You'll have some, at least whet your appetite, some takeaway, so you could take back home to your companies. Another nice cartoon that one of my guys on my team found. Many years in R&D, what do you have to show for it? Not even one eureka moment. Well, you don't need a eureka moment. That's not the threshold. That's not the standard. So when we talk about R&D from a tax perspective, what are we talking about? We're talking about anything from the point of ideation through commercialization. So again, a group of folks sitting in a room brainstorming about another product, another initiative, another way to manufacture something, all the way through commercialization. Once you commercialize, then this particular credit is off the table. There's something called the domestic manufacturing deduction, which then comes into play. But let me throw a question out at you, a classic example we can all relate to. What happens when General Motors has a recall of 10 million cars because the airbag is not opening up, right? It's not a chemical example, but an example that we can all relate to. And then they recall those cars and they try to figure out, well, why isn't the airbag opening up? I would argue, and many in our industry would argue, that then goes back into the R&D phase, right? This is then not non-routine testing. We got to figure out what happened. Why did the airbags not deploy in these vehicles? So after commercialization, the key takeaway there is after commercialization, there are exceptions, right? If you're addressing issues that are non-routine testing, figuring out issues in production, things like Six Sigma, lean manufacturing, TQM, just in time, all of these initiatives could potentially qualify post-commercialization. Four types of qualifying projects. So everyone is very comfortable with new product development, right? That's easy to understand. That's easy to get your hands around. But it's or maybe new process development. But the story doesn't stop there from the perspective of the tax code. Incremental product improvement and incremental process improvement can and should qualify as well. And we're going to get into in a second as to what do we mean by qualifies and what do you mean, what does qualify? So, but I want you to think in terms of these four buckets. And again, new to company, not necessarily new to the world or new to the industry. Identifying qualified research projects and initiatives. The IRS and the government requires you to take this credit on a project-by-project basis. They don't want you to say, okay, cost center A, that's just corporate, that's SG&A, and location B, well, that's all R&D. No. You've got to take this cut this on a project-by-project, initiative-by-initiative level, which is where we come in and we help you marry up the tax law with the science, right? That's where we add value. We marry up the tax law with the work you do, with the science you do. There are four primary tests that have to be satisfied to qualify. The first is you got to be improving the functionality, the performance, the reliability, or the quality of a product or a process. It could, again, and it doesn't have to be an entire product. It could be a part of a product. It doesn't have to be an entire process. It could be a part of a process. And I don't know if any of you are Shark Tank fans, but I took this from Shark Tank. From Mark Cuban, it's one of his favorite phrases. Granted, it has some aesthetic appeal, but I can't see any practical application, and for that reason, I'm out. It cannot be, your innovations can't be based on aesthetics or cosmetics. They've got to be based in satisfying one of the four tests on the left-hand side. One key thing I said, a subtlety, I said it quickly, one of the four. You don't have to satisfy all four, you just have to satisfy one of those four. The second test, and this is a no-brainer for anyone at this show, is it's got to be based in the sciences, right? It's got to be based in biology, chemistry, physics, biochemistry, engineering, mathematics, and it's got to be based in the hard sciences. Although you would be surprised many times, and actually the IRS is surprised, I'm not as surprised, many times we're able to capture the time of technical marketing folks. So it's not uncommon. You'll have a master's person in chemistry or biochemistry or engineering who also got an MBA from a top school, and he or she spends a lot of their time serving as the liaison between the marketplace and the company, discussing technical specifications, technical requirements for new products. That, if you can carve out that person's time, you can qualify their time as part of the calculation that goes into the research credit. There has to be some level of uncertainty at the outset. So it can't be that you knew out of the gate how you were going to attack the problem and it worked. There's got to be some level of uncertainty, of iterations, of trial and error. Otherwise, you knew what you were doing, right? It's funny, we meet with a lot of engineers and scientists all the time, and human nature is to not talk about your failures, right? No one wants to talk about their failures. But I always go in there, and my first statement when I meet with a group of scientists and engineers is failure is good. Failure is good for our purposes. It's the ultimate proof that something was R&D, right? If you tried something and it did not work, hey, Mr. IRS, we spent $1 million here on a project. It failed. It didn't work. So we can now capture that $1 million as part of the research credit calculations. So uncertainty for us is a requirement, and failure is a good thing. There has to be the fourth part of the test has to be some level of experimentation. Again, it could be trial and error. It doesn't have to be extensive. It could be parameters. We were trying different pH, different temperatures, different batch trials. It could be a whole variety of things. So process of experimentation, some examples, could be different pH, could be different concentrations, temperature, catalyst, vessel size, and so on. Many times the challenges will lie in the areas of reaction kinetics or thermodynamics or stability, yield, scalability. Scalability is a big issue. We have a lot of clients that say, well, great, we're able to make, I have several clients at the show. One of them is one of the larger companies here, and one of their biggest issues is scalability. They'll create something on a microgram, then they want to make kilograms of it. Well, huge challenges they run into. I mean, major challenges to go from milligrams to kilograms. So scalability is a good example. So phases of the experimentation, anything from ideation through commercialization, through that phase gate process can qualify for the purposes of the research credit. Qualifying examples: development of newer improved products, improvement of product yield or quality, purity, sourcing of raw materials and other inputs. Many times procurement can even qualify. If you run into a vendor that's not giving you the purity or the quality of an input you need, and you need to now figure out, okay, where can I get the quality or the purity of this input and make sure that it's serving my purposes, that effort, that time can qualify. Implementation of things like Six Sigma and Kaizen initiatives on the manufacturing side. Production scalability, we've discussed vessel size, material composition, system sizes, again, issues in reaction kinetics, fluid mechanics, and thermodynamics come up all the time. So new product development. Here's an example from one of our clients. The company developed a surfactant that it hadn't previously produced. It was uncertain at the start of the project whether the color specification for the product could be met using the company's production process. To achieve good color and activity of the intermediate, a good vacuum was required on the reactor to remove any excess feedstock compound. Again, if any air was sucked into the batch during the feedstock compound's removal, the color would darken rapidly, and that would not satisfy the requirements. Again, just an example, one example, and if you'd like, I could send you these slides. But again, issues of inputs, issues of scalability, of product purity, all qualify. New product development. A company undertook a project to expand the range and scope of a catalyst family by synthesizing 4 new compounds. And these are easy examples to get your hands around, right? This is new product development. What's even more interesting is our manufacturing issues you run into when, okay, I want to reduce waste. I want to increase the throughput. I want to create further efficiencies in the production line. Even there, we're able to qualify a lot of people's time and chemical that's wasted during these initiatives. I'm gonna skip through this. Again, the same types of issues, scalability. To talk about how you calculate the credit and what goes into the credit. So we've spoken about capturing this credit. Well, what are we capturing? So there are three primary ingredients or inputs that go into the calculation of the credit. Anyone who spends their time doing R&D, directly doing R&D, is going to qualify. So the first bucket is wages. So we use time to translate time into wages. So if Joe Smith is a PhD scientist, and you don't have to be a PhD, you could be a bachelor's degree scientist, who spends all of his time doing R&D, then you get to capture 100% of Joe Smith's W-2 Box 1, and you could sum this across all the Joe Smiths in your corporation. Well, that's great, but the tax code is actually even more lenient than that. Anyone who supervises or supports the R&D effort, their time and thereby their wages can qualify as well. There's a famous court case with Union Carbide, went all the way up to the Supreme Court. Union Carbide had, I don't remember if it was hundreds and thousands of individuals who spent their time cleaning laboratories, preparing laboratories for the PhD scientists and on the manufacturing lines to be able to do their work in the morning. The taxpayer, Union Carbide, at the time wanted to capture all of the expenses associated with all these individuals because their argument was, but for these individuals, our senior scientists, PhD scientists, lab scientists couldn't do their work. The IRS initially said no, the courts held in favor of the taxpayer. They said that all that time spent preparing the laboratories, cleaning the laboratories, getting them ready can be included. Furthermore, someone typing up a lab report, their time is included because they are in support of R&D. Supervising a laboratory, if you have a PhD scientist who's in charge of a group of scientists in running a lab, running several labs, that individual, even though he or she doesn't directly do any chemistry, the fact that they are supervising a group of folks that do qualify, their time could qualify as well. And you could envision many situations where that person's time could qualify. They sit in ideation meetings, they sit in product review meetings, things go wrong, they get called into the labs to try to figure out that people are picking their brains all the time. So it's not just the individual directly doing the R&D, but also the individual supervising the R&D and supporting the R&D. Another area on supervision of R&D, if you have this really applies to smaller companies. You'll many times have a CEO or a CFO who has a background in a science, right? Maybe they have a PhD, maybe they have a master's, but they have a deep technical background. And because the company is a small company, they've taken on the role of CEO or CFO, but they're also intimately involved in the science and the chemistry and the engineering that's going on in the company. You can even capture a part of their time as well. On the support side, and we touched on this earlier, if you have marketing folks who are technical marketing folks, they can get included in the support bucket. So it's really it's a very wide net of individuals who could potentially qualify. The individuals who never qualify and should be excluded, anyone in the accounting function, HR, legal, finance, taxation, all your traditional corporate folks, they should be carved out always, should never be included in an R&D tax credit calculation. That would be, if you include that would be an automatic red flag for an IRS agent who were to audit it. All those folks should always be out of the calculation. The second bucket, and this is a very, very big bucket for the chemicals industry. Most industries, this is not that relevant, but for the chemicals industry, this is huge, are supplies. Supplies consumed in R&D. They could be consumed in new product development. They could be waste from production lines. They could be materials consumed in trial runs. They could even be samples sent to your customers at no charge. So supplies could be a large potential bucket area for the industry. What's excluded? What's excluded is anything that's capitalized. So traditionally, I like telling my clients anything over $10,000. So if you buy a piece of equipment, Over $10,000, you capitalize it, really should be excluded for an R&D tax credit evaluation and study. Overhead is generally excluded. I have one large client. They are the largest consumer of electricity on Long Island. We were able to capture for them something called an extraordinary usage of utilities credit, which goes into as part of the R&D credit. They used, that one year, they used about $25 million worth of electricity at this one location. And so we were able to include that as part of the credit. The reason I mention that is because I have overhead as being excluded. Overhead is excluded to the extent that you're not using electricity or heat or anything else in your R&D efforts, and it's out of whack. In other words, like for this example I gave you, they were using at this one location $25 million worth of electricity in 1 year. So clearly, their electric bill wouldn't have been that had it not been for the R&D efforts that they were conducting. And then the third bucket is outside vendors. So let's say you don't know how to do you don't have the analytical lab to conduct some particular test, and you farm that out to another company. In that case, and this gets a little bit more involved, and we could talk about it if you'd like at the end, in that case, you can capture the money you spend on that third-party vendor. So let's say I have a very sophisticated NMR lab, and you don't have an NMR machine, and you send it to me to do the NMR, as long as, and I'll just give you a snippet into it, as long as you're on the hook financially, and you pay me regardless of the success, and you continue to own the IP on the project, you are entitled to the money you paid me as part of your research credit. So to kind of summarize, you need to own the rights and the risks on the expenditures associated with the outside vendor, the money you spend on the outside vendor. Those are the three largest buckets. There are other buckets that are smaller. If you spend money on university consortia, if you pay money to Tulane to do R&D for you, you can capture the money you spend on Tulane as part of the research credit as well. That was generally much smaller bucket. So there are two, and I'm going to try to make sure I don't get too tax technical. There are two ways to capture and calculate the research credit. So we take all these monies we've discussed, right, on wages, supplies, and outside vendors. We call it CR, and it all goes into a mathematical model, algebraic model, where it is calculated in relation to the prior 3 years. So the government wants to give you money to increase your spend of R&D. So it's in relation to a base period. There are two ways to calculate it. There's the traditional regular research credit regime, and then there's the alternative simplified credit methodology, which I highly recommend going with number 2 for a variety of reasons. It's a lot simpler to calculate. It's a lot more sustainable in IRS exam, and at the end of the day, it will give you a better mathematical result. This slide just summarizes the two methodologies. Again, the ASC, in my opinion, is much better, especially for companies that have not been around, into the 1980s. The regular methodology relies on a base period from 1984 through 1988. If you haven't been around in the 80s, I strongly urge you to go with the ASC. Again, in evaluating the two methodologies, the final calculus I tell my clients is not what I get you today to put on your tax return, because if you put a $5 million R&D credit on your tax return, and then 2 years later the IRS comes over and says, you know what, 2.5 of that doesn't qualify, and you were able to get 4 under the ASC, you're better under the ASC, right, mathematically? The ASC is easier to defend. We mentioned the states briefly. In addition to the federal credit, 37 states have their own R&D credits. There are a handful of states that have refundable research credits. That means that even if you are losing money, you will still get a check from the state. Again, one of my clients here at the show, one of the larger companies here at the show, for the longest time, they have their primary R&D facilities out in Iowa. And for the longest time, I was trying to convince them to do an R&D study, and they said, well, we're in a loss situation. We're not going to be, we have NOLs, net operating losses, and use those before you use your research credits. Anyway, well, they turned a corner. They got they're doing much better, and all of a sudden, we were able to get them the Iowa R&D credit, which is refundable. So they were able to get money from the state of Iowa, and now they've turned a corner. So all those federal credits that they've been aggregating, you get to aggregate them and carry them forward for 20 years. They're now able to use their federal credits and their Iowa credits simultaneously on Iowa and on the federal. So it's worked out really, really well for them. So, and the other thing to note is when you're doing a federal study, you might as well look at your states. It's only incrementally more work, and there could be substantially more bang for the buck there. We work with, so we have about a dozen companies at the show that are clients of ours. We work with them in a whole variety of ways. Anything from helping them marry up the tax law with the science they're doing. But at the end of the day, when you put together one of these studies, you really want to make sure you're dotting your I's and crossing your T's, because you're essentially saying to the government, hey government, I know this is out there, I'm entitled to take advantage of it, and it's a great benefit. Like I mentioned before, you're lowering your effective tax dollar for dollar. So you want to make sure you put together a package that, should you ever need it, and people ask me, well, how often are your clients audited? It ranges. I'd say it's anywhere from 6 to 10% of our client base gets audited. Generally, when you have very large credits, I have an audit that I finished defending last summer. The client takes $15 million a year. When you have a $15 million a year R&D credit, the likelihood is you might get audited. So you want to put together a package that really marries up the tax law with the science you're doing, and that's where we add value to our clients. Again, we don't take the role of anyone's CPA firm. We work with your CPA firm. We do a full study approach. People say to me many times, well, how do you know there's going to be a benefit, right? So I'm interested, but how do I know there's going to be a benefit? And how much do you charge, and so on and so forth. Before we even get into a study, if there's any interest, we do what's called a feasibility study. We do an upfront, no-charge analysis of where we think the credit's going to end up, right? Because I don't want to end up in an embarrassing situation either, where I come to you and say, okay, here's your bill for $30,000, and oh, by the way, your credit's $20,000. So we do an upfront feasibility study at no charge. It enables us to get a rough idea of where the credit comes out. We get a range, and then we can also build a range of the potential costs associated with doing the study, and we make sure it works for for our clients and for us. This is the ultimate goal. It's not just, like I mentioned before, getting the largest dollar amount on the for the company, but it's also sustaining it on exam. We have fantastic sustainability on exam, north of 98%, which means we've had to give up less than 2% to the service. We also, many times, companies will say to us, hey, we don't want, we have a large tax department, we don't want to engage you, but could you develop a tool for us to better capture documentation or better capture our costs associated with doing one of these studies? So we do whatever our clients need, from a full-blown study all the way down to developing a fancy Excel template or a fancy technical document template, a document tracker. Our role is to obtain the largest credits we can for our companies and defend those unaudited. We really see ourselves as the bridge between clients and the IRS in helping them capture these research credits. Our team is made up of scientists and engineers, like I'd mentioned. I don't want to mention this overly emphasize it, but it's a big deal, because when you go to audit exam and you sit across the table from the IRS, if you could speak the language of the science in addition to the tax law, it's very helpful in defending these. We probably do more in the chemical industry. I grew up, after my life in chemistry, I worked in management consulting for a few years, a firm called A.T. Kearney. I don't know if anyone's heard of them, out of Chicago. And then for the past 14 years, been working in federal taxation. I grew up in Ernst & Young and then Deloitte, and now leading up the practice at Anshin out of New York. I could tell you that for certain, in the chemical industry space, outside of the big four firms, outside of the Deloittes and the PwC, KPMG, and E&Y, we probably service more chemical companies with respect to the R&D tax credit than any other firm outside of the big four, any other firm in the country. And we do it in all phases: organic, inorganic, biological, energy, oil, polymer chemistry. Our sweet spot is the middle market. We love companies in the $20 million to $500 million space. We can add value. They appreciate us. We're not just a stock. We're not a stock price. We're not, oh, great, our earnings. We deliver value to the owner, direct value to the owner, the owners, to the bottom line. So that's a little bit about us. And if you have any questions, I'd be happy to take some questions. If you have any questions, yeah, question. Great, a question about. But I'm sorry, I can't do that. Does everyone qualify, simply if I can summarize the question, does everyone qualify? Oh, sorry. I was just saying that's a great question. Her question was, I didn't catch your first name? Annalisa asked a great question. She said, well, you mentioned that it's not just the direct people doing R&D, but also the supervisors and the folks supporting them. When I do the calculation, does everyone qualify? I think I lost the mic. Does everyone qualify at 100%? The answer is no. What we do is we come in and we interview folks. We spend, and our larger companies will spend a week, 2 weeks, depending on the size of the client. We interview people to understand and vet out how they spend their time. Sometimes companies have time tracking. That makes it easy. If they don't have time tracking, we interview people to understand how they spend their time. It could be anywhere from 0 to 100, Annalisa, anywhere in between that range. So that's a good question. No, not everyone is 0 or 100. It could be anything in between. Again, that's how we're adding value, is by vetting out their contribution to the R&D effort. Good question. Question? Time. If you have any other questions, if you'd like to discuss some more, I'm going to be here through the end of the day tomorrow. And thank you so much for coming. Thank you.